Okay, so we have IAS 37, IAS 37, how to account for provisions, contingent assets, and contingent liabilities. Let's look at the issues. For now, the way they are testing the standard, I don't know. Corporate reporting, it may be likely you will not have the normal one. Financial reporting, it is also likely you will not have any normal one. So we should be learning new things on what? Reassessment, remeasurement, remeasurement of environmental provisions where discount rates and other things may differ, may be reassessed and other things like that. So if anything has to do with this standard, then you should be expecting remeasurements or reassessment of provisions, environmental provisions, where they will give you the provision, where they will give you the provision with the present value in the next 10 years. Then they will give you the provision that the provision has now been reassessed from, let's say, 200 to what? 100. And then the discount rate will also differ. So mainly today, this is what we are coming to learn about. The rest, the other one there, you already know it. So I will not waste much time on that one as well. My only issue will be on the reassessment of these provisions and other things like that. I believe it's okay, right? I know some of you will be hearing it for the first time. Remeasurement or reassessment of a lease, just as we have reassessment of a lease, reassessment of provisions and other things. You know, now ICAJ is trying to be so technical. They are going into the advanced side of the standard, because things are not normal nowadays. So if you also don't strategize and read widely, then you may be laughing at the wrong side of your mouth. So provision. What is a provision? Provision is something that you have no idea. No idea of either the amount or the timing of its occurrence. So you are just making what? An estimate into the future. You already know what a liability is. A liability is a present obligation, blah, 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 blah. How do we recognize a provision in a financial statement? We are saying that we only recognize a provision when the entity has what? A present obligation. And this obligation could be what? Legal or constructive. When we say legal, it means it's by law. Constructive means by way of past practice. By way of past practice. What I mean is that if we say a constructive obligation, a company may have a constructive obligation in a situation whereby, let's say, S&D is in the mining sector. Please, this galamsey issue, the way this galamsey issue is becoming, if you go and you see anything on environmental provision, don't be surprised. Galamsey. So please, let's be serious on this standard, right? So S&D is in a mining sector or in a petroleum, whatever. Let's say mining. And then they have given S&D concession for some time. Then, in the area where S&D operates, there is no law. There is no law for S&D to reclaim the land at the end of its concession. There is what? No law. There is what? No law. But S&D is a company of good reputation. And in the previous sites or concession that this thing S&D had, they always reclaim the land whenever they are done. And this thing is known to the area where S&D is operating. So you see that you're by way of pattern of practice with your previous decision, you have created a valid expectation in the eyes or in the public that this is what you usually does. So this is what a constructive on yourself, even though there is no law backing it, you have created this valid expectation that that is the way you operate. And for that matter, the community or wherever can hold you responsible even if you fail to do it. That is constructive obligation. That is constructive obligation. By law, dear law, you have been given a concession, and it is by law that anytime you finish, you need to reclaim the land. You have to level the land and restore it to it from previous position. I said Galamsey issue is becoming a national security in this country. Beware of IAS 37. All right. So let's come to 2. It is a probable outflow. You see, it is what? It is probable that we will need what? A cash flow to settle that what? Obligation. So the recognition criteria for a provision is not all that different from that of what? A normal liability. And we can say that a reliable estimate can be made of what? The amount of the provision. So the provision here, it is not talking about the exact amount. We are looking at what? The best estimate. The best estimate. And you know that a provision is an example of an accounting estimate under IAS 8. And the law on IAS 8 says that all accounting estimates must be what? Applied prospectively. And accounting policies must be applied retrospectively. So prospective application means that you correct whatever being the provision, and then you move on like that. An estimate is a what? A provision is an accounting estimate. So you correct it in the current year and thereafter. But when we talk of retrospective, then you go backwards to do what we call retrospective application. So if these conditions are not met, provision cannot be what? Cannot be what? Recognized. It cannot be what? Recognized. So it doesn't mean that all these conditions must be met. So at least you must have a reliable estimate of the amount and then anything like that. Okay. Any question? So the legal or constructive obligation. So I said constructive obligation or legal can be derived from a legislation or what operation of the law. A constructive obligation is when an entity pass or publicize, create a valid expectation among what parties. You have been doing it, and then the entity community expect that you will not do what? Deviate from your past practice. That is a constructive obligation. A constructive obligation. Galamsey. Eh? Galamsey.
Hello, sir.
Yes, sir.
Hello, sir. So should all the 3 conditions be met?
No. I said it that any of them where any of them is present, you can go ahead and then what? So if there is a present obligation, we are to pay something now because of the past events. Yes, that is a contingent what? Liability, or that is a provision. So we'll just look at some few things and then we go. So let's look at illustration number 1 on a provision. S&D has a policy of refunding purchases by dissatisfied customers. Even though S&D is under no legal obligation to do so, its policy of making refund is generally known. So you see such a thing is what? Generally known. That is what? A constructive obligation. That is a constructive obligation. So they said that should a provision be recognized? The answer is yes. Why? Because this is what? A constructive obligation, and this policy of refund is generally known to everyone. And therefore, if I buy it and there is any issue, I have the right to confront the entity for that refund, even though there is no law backing it. Any question? All right. So a reliable estimate, when we say a reliable estimate, we are talking of what? The most likely what? Outcome. The most likely outcome. The most likely outcome. So if the provision is made, so if the provision is made on several events, probability of this occurring is 10%, this and this. So it should be based on what? The expected value. Then probability of, let me give you an example. Let's say Desmond is in a process of preparing its accounts, and he cannot accurately determine the costs it incurred in renovating its office. But he can recollect that the amount is not less than 1,000 Ghana cedis and not more than 4,000 Ghana cedis. What is what? The estimate of this provision that that we can include in the financial statement.
As a 4,000.
Yes, it should be the highest amount. 4,000. 4,000. Okay. So the expected values. These are all not anything. I'm telling you that these are all normal numbers. And then the way CA questions are going, the normal will not be normal again. The normal will not be what? Normal again. So let's take illustration 2 on expected what? Values. An entity sells goods with a warranty covering customers for the cost of repairs of any defects that are discovered within the first 2 months after the purchase. Past experience suggests that 88% of the goods sold will have no defects. 7 of them will have what? A minor defect, and 5 of them will have a major defect. If minor defects are detected in all products sold, the cost of repairs will be what? 24,000. Expected value. If major, it will be what? 200,000. So what would be what? What would be the provision that should be made? It should be based on what? Expected value. 88 there will not be what? Any defects. So you make the probability based on the expected value of what? The defects. It's just so simple. They are saying that 7 of them, 7% will have if 7% 7% minor, and its cost of repair will be what? 24,000. Like this. Plus the probability of a major defect of what? 5%, and its cost of repairs is 200,000. The amount represents what? The provision that needs to be what? Recognized. Any question? Expected value. So what is the answer? Expected value. Okay. So that is the answer on your board. Let's talk of best estimate. S&D has to rectify a serious fault in an item of plant that it has constructed for a customer. The individual most likely outcome is that the repair would succeed at the first attempt. But there is a chance that there is a chance that a further attempt will be necessary, increasing the total cost to what? 500,000. 500,000. So what will be the what? The provision that needs to be what? Recognized. So what is the most likely outcome? The best estimate. The best estimate is that whether or not the further this thing would occur or not, all this thing must be based on what? The first attempt. Because the most likely outcome is that you would, for the best scenario, for the best estimate, you will always what? Take the worst case what? Scenario, the worst outcome. All right. So we are saying that the provision that should be recognized should be 400,000. This is because of the liability is each what? Most likely outcome, not what? The worst scenario. So there's a possibility. They said that, but there is a chance. There is a chance for what? A further attempt. So where there is no chance, whether the chance will be available or not, we don't what? No, we don't know. But this one there, it is always that the destiny will succeed. So the best one that we can talk about of the estimate should be the one that is likely or most likely, which is the 400,000. Contingent liabilities. You know the definition of a liability, but the contingent liability is that the liability will occur based on the happening or non-happening of an event. Simple. That is the definition of a liability. This is what a possible obligation that arises from a past event and whose existence will be confirmed by the outcome of uncertain events, which are outside the control of management. So we are saying that liability will be based on an outcome of a certain event, a certain event. All right. Or it can also be a present obligation that arises from past events, but does not meet the criteria for a provision. Does not meet the criteria for a provision. Does not meet a criteria for. So what is a contingent asset? That is also a possible asset. The possible asset, which would be what? Which would also depend on an outcome of an event. Which would depend on an outcome of what? An event. So you see that we'll come to the recognition criteria for a contingent liability and a contingent asset shortly. Contingent asset and contingent liability. But in any case, the prudence concept is always paramount in this case. That is to say that we don't jump into consideration, conclusion, and then recognize contingent asset just like that. But for contingent liabilities, hey, when there is a small chance of it occurring, just as the prudence concept always advise. All right. So let's look at the probability and then let's say some general rule. That is, we are saying that when you are virtually certain means that you are 1,001%, 100% sure that it will happen. So if it is a liability, an outflow is a liability, this one is asset, like this. So we are saying that if you are virtually certain that this thing will happen, you will recognize a liability. Then in the case of an asset, you recognize asset. How will you know it is virtually certain? You have an insurance claim. You have an insurance claim for a fire outbreak. This fire outbreak, the insurance company came to assess the liability, and they have confirmed that they are coming to pay to the extent of them signing the thing that yes, This is the amount they are what they are going to pay. So you are virtually what? Certain because of A, B, C. There is what? A firm and 100% commitment. That is why we are recognizing contingent what? Assets. Okay, when we say it is probable means that it's likely to happen. It's likely to happen. So if it is probable, you see that percentages, this is just a guide. If it is probable, I told you for the liability there, you'd recognize it. But for the asset, we don't recognize. We disclose. Please, under IAS 37, if you are answering questions under IAS 37, you should be very careful with your choice of words. Recognize. Recognize here means that you bring the amount on the face of the financial statement. So if it is something that needs to be disclosed and you said it must be recognized, totally zero. So recognition here means that we are incorporating the lesson in the financial statement. Disclosure means that it must appear in the notes. So if it is possible, possible means that it's not probable. So the possibility is that it's from 20% to 49%. Then we can disclose what? A contingent what? Liability. Look at the probability. 40 to what? 50 to 20 to 49. Disclose. For this one there, you ignore. If it is a liability below 20%, you ignore at both what? Ends. Both ends. So be guided by this possibility, probability, and then virtually certain. Virtually what? Certain. So let's take our first example. Example number 4. Yes, somebody should read it for us.
S&D operates in the oil industry and is regularly involved in the contamination of land, seas, and rivers, given the nature of the business.
So
it does, however.
So you see how if you switch on your TV, galamsey everywhere, pollution. I am saying that don't be surprised if you see galamsey related issue under IAS 37 in your exams. Senior, continue.
Okay, so explain how S&D should account for the above environmental cleanup costs in its financial statements. S&D operates in the oil industry and is regularly involved in the contamination of land, seas, and rivers, given the nature of the business. It does, however, have a publicized environmental policy on its website and in its annual report that states that it will clean up any environmental damage incurred.
So this is once they said that it is a policy that they have and it is well known, it is publicized, that they will do what? They will incur any environmental damage. This in it is what?
A constructive
obligation, right?
It is currently involved in 3 major projects where the cost of cleaning up the contamination and the local laws regarding environmental cleanup are given. So we have environmental cleanup costs, then we have the local laws.
Yes.
So 4 million, the law enforces the cleanup of environmental damage.
Okay,
5 million.
So let's analyze them like that. They say environmental cleanup cost. The cost here is 4 million cedis. And the additional information on there is that there is what? A law enforces the cleanup environmental damage. Should they recognize the provision of 4 million or not?
They will, because it's legal.
It is what? Legal. It is what?
Yes.
Legal. So we are saying that explain
code.
how S&D should account for this cleanup what? Costs. They say it is what? Legal. It is what? Legal. For that matter, it is, you don't have a choice. It's just like tax. They say you should pay tax on 5% of your earnings. You don't have a choice. It's by law. This one, it is by law that you must do what? You must clean up. You don't have a choice. So 4 million should be what? Recognized. Any question on that? The second one is saying that 5 million And the information on the 5 million is that there is no law exists for the cleanup environmental damage. Should we recognize the 5 million?
Yes.
Yes,
because they have
it's on the website.
Yes, we need to recognize it because of this constructive obligation. Constructive obligation. There is no law, but the company has taken it upon itself that this is what they does. Everybody is known. It is publicized. So they can be what? Hold to that what? Obligation, even though there is no law. So for now, we are saying we'll recognize what? The 4 million, we'll also recognize what? The 5 million. Let's go to the 6 million cost. They say law to enforce this environmental cleanup will come into force in the coming accounting period. In the accounting period. Will come into force in the accounting period. Are we going to recognize that provision?
Yes, sir.
Yes. Are we going to recognize that provision?
Yes, because of the same constructive obligation that they have.
Yes. So the thing is that the law is yet to come, but the constructive obligation is still on them. Even if the law doesn't come, they will still be the constructive obligation is holding their neck. They can't do anything. Please, are we all okay? Are we all okay?
That's it.
So the total provision that should be recognized is what? How many? This plus this 10. So that's 15 million. We are recognizing all the total. So let me amend this question. In a situation where the company doesn't have any publicized environmental policy, how much should be recognized as a provision?
4 million.
4 million. Thank you.
Yes.
Is it okay? That one,
yes.
There is no constructive obligation on the entity. It only goes by the law. If the law says do this, he does. If he say don't do it, he doesn't do it. So assuming there is no constructive obligation on S&D here, the only provision to be recognized should be what? 4 million. All right. So let's move to the next one. So please, what we have said is the solution is there, but the understanding is what? More important. Once you understand this, there's no need to even go through the solution again. Do you all agree with me? Because when it comes like this, you can use your broken English to do this. Yes, warranty provision. Warranty provision. What is a warranty? You will see that you buy an air conditioner. It is only Ghana that these things are not enforced some way. You buy a Samsung TV right now and they say that 10 years warranty. An air conditioner and this and this. But the question in Ghana here is that if this thing occur before that, have they been refunded? Have they been doing what they're supposed to do in Ghana here?
Some does.
Some does. Some does. Some does. Okay. But you know, if they fail to do it, once that warranty has been given to you, please proceed to court. You win without the services of a lawyer. Just get some pocket lawyer. Just prepare your writ of summons and then your motion, and go and move your motion. We don't need a lawyer to win that case. The issue is that you have a warranty of 4 years. I've bought the goods. This is my first year or my second year. Even if it's on the last day of the 4th year, you still win the case. So please, this is just an eye-opener. Come and pay for your consultation fee of what? 500 Ghana cedis for this information. All right. Sorry.
Cost-benefit analysis.
You there?
That a cost-benefit analysis you will not even want to do.
No, you see, if you've bought an air condition that costs what? 10,000 Ghana cedis. 10,000 Ghana. I said you don't need a lawyer to win this case like. You don't need a lawyer. Just let somebody prepare your writs and then your motion for you. Go to court. You go and stand there. You need some company lawyer, pocket lawyer to tell you. Then you go, the judge will give you or this thing too. Then you start to move your motion. Yes, my lord, I stand before you today on so and so. I file a motion with it accompany affidavit, this and this and that and that and that. These are the things and that and this. I stand by my motion and everything before you. The judge will look at this thing and then, grant you all that you needed. Even though they would bring some kind of opposition to it. But the thing is that they have given out what? The warranty. All right. So,
remember, terms and conditions apply.
terms and the terms and conditions, what are they?
You go home with nothing.
Oh, the terms and conditions, what is the terms of condition? The terms of condition is that, what? Okay, you don't worry. Don't worry. TNC applies, yeah?
Yeah, we'll meet in court on Monday.
Oh, come and meet me. Come and meet me. We'll go to Supreme Court. Come and meet me there. You see, Charlie. Okay, let's go on. So these warranty provisions, how should we recognize these provisions? You are selling, you have given out 10,000 units, you have produced 10,000 units, and there is what? A warranty on all the units produced. All the units produced has the warranty. How do you do what? Recognize this warranty. How will you recognize this warranty? Please, 1 minute. Sir Stephen is calling me.
So you have unmuted yourself.
Oh, sorry. Oh, sorry. I'm saying that how will it be made? You know, the provisions will be made at the time that you are selling. And this one will be based on what? A past practice or a past event. That, last 3 years, this is what has happened. We are not talking of what the exact amount, just what an estimate. So the issue is that how many claims will be made. If the manufacturing techniques improve, then it means that your past thing there will be an improvement on it. So all these are all what? Estimates. Last year, this was the efficiency level and this. So if things has improved, then we mean that this and that would also what? Reduce. How much will it cost to repair? How much will it cost to what? Repair. Okay. So we said that a provision needs to be set up. A provision needs to be set up at the time of what? The sale. When you are making what? The sale. So what will be the expected future repairs? So this one will be the number of units that is expected to be what? Repaired, multiplied by the costs. Multiplied by the costs. So if the probability is what? 40%, 40% that it will happen, and the total cost is this, it is what? The percentage times what? Just as we did the previous one. Just as we did what? The previous one. And at the end of each reporting period, you need to review this estimate, whether at the time of making that estimate, whether some conditions have changed and needs to be what. All right. So let's do this. Let's do this. Yes. And a woman should read now. A woman should read.
Illustration 5. Clean sells domestic appliances such as washing machines, On 31st December 2021, Clean decides to start selling washing machines with a warranty. Under the terms of the warranty, Clean will repair washing machines at no charge to the customer if they break within the warranty period. The entity estimates, based on past correspondence with customers, that 20%, sorry.
Yeah, you are on course.
Okay, that 20% of the washing machines sold will require repair within the warranty period at an average cost to Clean of 50 Ghana cedis per machine. Clean sold 200 washing machines on 31st December 2021. The
So
time
what?
value of money should be ignored.
All right. They say time value of this should be what? Ignored. If there is no time value of this, then maybe in the warranty is for 4 years. 4 years period. And we are expecting that the cost of this repair will be an average of what? 50 cedis per repair. How many units were sold? 200 units multiplied by 50. That will give us how much?
10,000.
This will give us 10,000. And then the probability of its occurrence is what? 20%. What is the 20% of the 10,000?
2,000.
2,000. So this will be what? The provision that is likely to do what? To occur. So if the question has given you a discount rate or an incremental borrowing rate of the entity, after getting this 2,000, you need to what? Discount it to its what? Present value. Is it okay?
Hello, Sir Desmond.
Yes, sir.
No, sir, it's not okay.
Yes, if it is not
The
okay.
4 years, please, the 4 years, is it by assumption?
Yes, I am saying that the question says that the cost of the repairs, they are saying that 20% of the washing machine will require a repair at a cost of what? 50 cedis per machine. And then a total of 200 units of machines were sold in December 2021. The time value of money should be what? Ignored. But I'm saying that assuming this one is not here, and the question says that the entity has given what? A 4-year warranty. A 4-year warranty. And they have given you the cost of capital to be 10%. Then you should know what to do. Time value of money. Discounting of what? The amount. The expected value. Yeah.
So it means that if such a case exists, then after every year you'll be unwinding the
You'll be
discount.
You'll be unwinding the cost. You will be what? Accumulating the cost. That is it. Any question?
So the 20%, is it on the total of the 200 machines?
Yes, please. The probability.
So it is the 20 times 50 times 200. The cost per each maintenance is 50 per machine times the 200. That would be the total cost of maintaining the 200 machines.
Times the probability. The probability. The probability.
Then find 20% of the it will be 1,000. 20% of the 1,000.
20% of the 2,000. The 10,000. They say 20. They say 2,000, not 1,000. So that is exactly what is on your board. The 20 units is 200 units multiplied by the probability of its occurrence to be 20% times the cost per each repairs. So assuming it is time value of money, remember to discount this at the what? Appropriate discount rates. Any question? All right. Then we are moving to the end of the show. Guarantee. IAS 37. This one have guarantee. You see, if you want to take loan at GCB Bank, then after the person going through this thing, they will give you some form that two persons should guarantee for you. That thing that we have been doing without a reasoning, or just that if you fail to do, the person might think that you are so wicked and that thing. Please, that thing is a very risky thing to do. It is a very risky thing to do. You are guaranteeing that in the event that the person failed to pay, you should be held responsible for it.
Will fall on you.
You fall on you. You fall on you. You see, but sometimes me, I always make it so diplomatic. When you bring the form for you, you see, most of my this thing will come. It will go for GCB. When they come, they will say that, oh, sign the guarantee for. Oh, I said no. You let me sign the accountant portion for you. Let me sign the accountant portion for you so that these people should guarantee for you. I don't want any liability because I know the implication of IAS 37. Then, if the person fails to do no, then a GCB will lay embargo on your account. When you are not able to access this thing, you go to the banking hall and they will tell you that this is due to a guarantee that you have made, and the person is nowhere to be found, or we can no longer deduct the amount required. Then that you know the essence of these things that we have been doing. So what we are saying that when can an entity recognize a provision on a guarantee? We only recognize a provision on a guarantee if there is an evidence that the financial status of the person that you have guaranteed has deteriorated to the extent that he or she will not be able to pay the liability. Example, S&D has guaranteed loan for Desmond. At the time of this guarantee, Desmond was in a good financial strength condition. So in this year that they have this thing, there is no present obligation on S&D. Why? Because the financial stability of Desmond is very sound. But the only thing S&D need to do is that they have to disclose it in the note. Let the shareholders know that, yes, we have guaranteed so and so amount to Desmond. As at this time, there is no obligation to pay anything because the Desmond is in good health. In an event that there are symptoms of cash flow issues, and it is likely that Desmond will not be able to make, and this information become available, then S&D need to do a provision for the guarantee that they have paid. So you can only do the provision where this thing has deteriorate. So that is it about guarantees. Any question on guarantee? If there's no question, we pick this question and then we move on. Yes. Any questions? Bosu?
This guaranteeing of loan, let me show you a very nice way of dodging it.
Okay.
You see, the banks, before you can guarantee a loan, you must be an account holder.
Exactly. So.
You must have an account with the bank. So one nice way of dodging is to tell the person that you don't have account with GCB. That is all.
Oh, no. The issue is that the person knows you all take money from GCB. The person knows.
Unless of course the person knows you take your salary from.
Oh, the person knows. So you see there's a portion there. There's a portion that people will say that the accountant and then HR should sign someplace. Yes, I am the accountant. I said, let me sign accountant portion for you.
Portion.
Yes, I don't want any obligation.
That one they won't follow you.
No. I don't guarantee. I'll say that, you need two things. You let me stamp accountant column, then bam, I stamp it for you. Me, I'm done. Go and look for somebody to guarantee for you.
So, are you saying that you don't trust your own staff?
Oh, master. Hey, in this world, you want to trust somebody. Somebody has taken
the word. Matter of trust.
Somebody has. If you are ignoring to guarantee, there is trust.
Master, you are in this.
Let me give you.
Yes.
Let me give you a practical.
If you are signing on behalf of the company, you are not going to be liable yourself. You are signing in capacity as the accountant for the company which you guys are working for.
No,
so
I am
being held personally liable.
I am signing as an accountant, saying that the salary of so and so will pass through your bank. That is my duty as the accountant.
Yes.
Yes. So
and are you signing as an accountant in your personal capacity or on behalf of your firm?
That's I'm on behalf of the firm I work with. And I'm saying that.
So you will not be personally liable
no,
to the firm or?
No.
You're not personally liable.
The issue is that if you want to sign this
because you are acting in capacity for the firm.
Yes, look at
it's the firm. He's signing as accountant representing the firm.
See, the form says that
because usually there's HR portion.
You see, that form, no, I'm always comfortable with GCB1. The GCB1, the accountant portion is signing and confirming that that is where the person received the salary. And you will ensure that the salary will still pass through GCB for their deduction. So that is my duty as the accountant, that I must make sure the salary passes through GCB. That is the end of my work.
Exactly.
So in an event that this person take the loan, he went in for, let's say, 200,000, and all of a sudden, Pam, the person, go Canada. So the people who have signed for this thing, those are the people who will be held responsible. So the person asking me whether I don't trust this thing, I don't trust anybody, including me myself.
No, you don't have to. When it comes to this thing, you don't have to trust anybody.
You don't have to play with certain things. The person will
that's what. Let me give a practical experience.
Yeah.
These days, some banks are even not giving loans to nurses. You know why? Because the nurses, Canada is taking a lot of nurses. So what some health workers are doing is that they come for bank loan. After getting the loan, they just pass to Canada. So in this case, those who guarantee the loans, the bank will fall on them to pay the loan.
Exactly. So please, before you guarantee for this thing, see, let me tell you, this is a personal. I work in the courts, and then I have always said that to stand as a surety for someone in a court is only my wife, not even my mother or father. It's only my wife that I can do for. That is all. The rest is I cannot do it for anybody, and I know why I'm saying that. Master,
that's what.
This surety and this guarantee, it is the same thing. I have we have a defrauding case at the court of over 200,000. The person has defrauded the people that he will do this thing, custom move for them, and he has taken sums of money from 5 good people, totaling 200 and something thousand Ghana cedis. Now they move to Pafka. When they call him, blah 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 blah, and they were able to fish him out, and he was arrested. A certain chief came that he want to stand surety for the person, and I asked the chief after filling the form, "Do you know him?" He said, "Oh, the guy is my niece. He will not run away. He will not do anything." He has signed. He has just signed the surety for him. As we speak now, we don't even know the whereabouts of the guy, and the person who stood surety for them is being held liable to pay the money. And so far, he has paid more than half of this amount. So please, these guarantees and surety at the court, please, if it is not your wife, your husband, if it's your brother, please don't do it. Your brother will say that, oh, this one is a family matter. He will run away and you will be held responsible.
Yes, someone is in jail because of that, so yeah.
For your wife or your husband, your wife, it is somebody's child that you brought upon yourself. Even if she has run away, you have enjoyed something. At least, you give birth to some beautiful children for you. Oh, see this one.
I like Desmond for being fun.
That's one. That's one. You say if it is your wife, you have enjoyed something. have you enjoyed?
Oh, you have enjoyed something at least. Yeah,
God bless you. God bless you, Tedes.
at least somebody who has sacrificed her life to give.
On this note, the wife should also guarantee for the husband. So if the husband runs away, the wife has also enjoyed.
Exactly.
It's
That's what
vice
I'm
versa.
saying. That's what I'm saying.
Both parties will enjoy.
Okay, so that is the issue of guarantee. Please, if you go and these are some of the things that you need to remember in the exam hall and write something. If not anything exactly, something will come out in your mind. Illustration 6. S&D Limited gives a guarantee to a certain borrowings of 𝑰 Limited, whose financial conditions at that time were sound. During 2020, due to the COVID-19, coupled with the Ukraine-Russia war, the financial condition of 𝑰 Limited deteriorated. And on 30th June 2021, 𝑰 has filed what? Protection from its what? Creditors. From its what? Creditors. It means that this person is in what? Financial difficulty and has filed that those creditors should not do what? Should not sell their property. So it means that at that time, 𝑰 is in the what? A financial difficulties. So what is the treatment? They say, what are the accounting treatments required? As at 2020. As at 2020, what is the condition of 𝑰? What is the condition of 𝑰?
He had a sound financial
yes,
condition.
so as at that time, there is no present obligation for any liability. Therefore, the only thing that needs to be done is to what? Disclose the guarantee in the notes to the financial statement. In the year 2021, COVID-19, as the question went, COVID-19 has destroyed the fundamentals of 𝑰 Limited, and 𝑰 Limited now is in the financial difficulty. So now, do you think a provision is required for S&D to do now?
Yes.
Yes, because it becomes so clear that S&D will be held liable for the debt of what? This company. And the best estimate of this amount must be what? Determined in order to recognize a provision. Any question? That is the answers to these two questions. When your finances are good, you don't recognize because there is no obligation. You only what? Disclose it in the note. When the things go bad, that means that you need to recognize a provision. If the amount is not given, the best estimate ever should be what? Used. Any question?
Thanks.
Madam.
Please, in case of the death of 𝑰, how would the recognition be?
How would who?
In case of death of 𝑰.
Yes.
How will it be recognized?
Yes, the debt of the 𝑰, the question will give you the loan amount that he has what? The amount that he has guaranteed. So that is the amount that he will personally be held liable. But in a situation where the question of this nature is given, then there's no amount there. So you say that a provision should be what? Made of its what? Best estimate of what? The likely was the likely amount. So you know that in 2020, maybe the value of the loan might have reduced because he's servicing the loan. So it is at the point where it becomes difficult for him. That point, the amount available at that point is the amount of the this thing. What do you call the amount of provision that is what required? Madam, are you okay? All right. Galamsey. I wish this thing should come on. This what do you call? labor, this TUC thing should come on, so that we'll rest in the house more, and then my students will get time to learn. Does this?
Oh, sir, that's true. We are praying for that. We are praying for that.
No,
we are even tired.
So does it work for private companies?
That's what I want to ask. That's what I want to ask.
No.
Private companies are excluded.
TUC has asked the private institution to
go to work.
No, they've asked the private institute to join. Just like
Now, when we talk of organized labor, private companies workers are involved.
I'm saying TUC is pleading that
is it obligatory
to come
is
and
it
join.
obligatory?
No,
No.
private person.
So those who are working in the private sector, you cannot abandon your work and go join an organized institution. By the time you come, they'll replace you. By the time you come back, they'll replace you. So you have no option than to go to the office.
So my people, those in the private sector, I beg you, job no day. So please, if they said they should please go to work, okay? Please
you compare yourself to the government workers and see. You will see your Sonia.
Okay, sir.
I'm coming. What this Mr. Mack is saying, there was a time there was some there was a time there was some nationwide protest and then a person from a private entity was given
vigil. The Doomsday vigil.
Yes.
Yeah.
She
and the lady was fired.
She applied for a leave that she was going to hospital or something. The next day he was seen on television demonstrating and you see. So I beg you, those in the private sector, please go to your work and save your job. All right.
Then what if it's for manager that we should join? Maybe the manager is annoying.
Okay, so we are saying that yes.
Question, please. There's a scenario on the Galamsey issue that's how the question can relate it to a question, so that we see how it.
Okay, no problem. Don't worry. By the time we finish, we'll have a feeling of that. Okay, so do we do provision for future operating losses or future repairs? The answer is no. Why? We said a provision is what? A present obligation as a result of what?
Past event.
Did he say future events?
No.
Yes, because the future, you don't know what will happen in the future. If they are saying that the future, this and this will happen, you are going to do this like this, management can change its plan. Do you see that? So we don't do provision for what? A future program like repairs or future operating losses. You are estimating that in the future there will be what? A loss. There will be loss. Now, in the course of the year, Mr. Olua, I'll come to you. In the course of year, you have changed. You may decide to change your method of operation, and that future loss will never occur. For that matter, there is no present obligation, and for that matter, we don't do provision for what? Future repairs as well as operating losses. Yes, Mr. Olua, let's hear you.
Sir, please. I'm really confused.
Hey.
Please, can you hear me?
You are a lady, right?
Yes, please.
Are you a Nigerian?
Yes, please.
Oh, yes.
Mrs. Olua.
Mrs. Olua. My former boss, 𝑰𝒏𝒂𝒏𝒄𝒆 Ganikale, and his boss too is called 𝑰𝒏𝒂𝒏𝒄𝒆 something. Okay, madam, let's go.
So please, I wanted to ask, the Galamsey issue that you were talking about, how does it relate to what we are doing? Because you said providing for liability. So how does I don't understand what you were saying.
Okay, Galamsey. Why are we saying Galamsey? These Galamsey people, they will always
no Galamsey in Nigeria.
they will dig the pit and leave it just like that. Do you get it? They will not reclaim the land, which is causing life and what? Property. So I am saying that you don't worry. Galamsey. Don't worry. We will see a question on Galamsey. Don't worry. Okay?
No, so I'm asking, it's not just the Galamsey, but like, how do these situations relate to what we are doing? Because I thought we are preparing like the statement for like a company. So these outside issues, and I don't get what is
okay. So
like.
so the Galamsey, is it not companies that are doing the Galamsey? No individual is doing Galamsey. For it can be a small company that is into what Galamsey.
Yeah, a small mining firm.
Akonta Mining, Mutumi and Co.
Yeah.
They are all companies, right? So we are saying that how would Mutumi Akonta Mine, as an accountant there, how will you account for a provisions of that nature? That's what we are saying. So,
Okay.
So we are just saying that, okay, Galamsey, they will dig the pit there and leave it like that. Now that everybody is crying, hey, Galamsey here and there, Galamsey here and there, we are expecting every mining company that at the end of their concession, if they are not polluting the environment, like let's say Newmont like this is a world. So we expect them that after digging the place and then mining the place for some that period, what should they do? After that, they need to what? They need to level or reclaim the land. That's what we are talking about, madam.
Please, thank you.
All right. So that is it about.
Please, so the judge, is judgment debt related to what we've been discussing? Judgment debt. Yeah.
From the judicial service of point of view or what?
Yes, please.
Hey, Madam Mary, which court do you work?
It just came in mind. I want to know maybe if judgment debt in the public sector.
A judgment debt. Like Muwoyome debt, right?
Yes, please.
I just want to share a view on that before you come in, if I can.
Okay. Oh yeah, please.
The judgment that comes about as a result of past work or past experience. So I think a provision should be made. That's my listen though.
Exactly so. So we'll come to court cases and then other things like that in the short.
Thank you.
All right. So this is about future operating. So they can give you this thing that they will give you a whole scenario that the company is operating this and that and that and that. That is so efficient and that. And after the COVID-19, it is expected that in the future, the company is expected to, or this DDEP like this, the company is expected to lose so much like this. Then the accountant is of the view that he would recognize a provision against the coming year. It is testing your knowledge on how to recognize what a provision for what future what cost. So please just understand it like that. Just understand it. So they can give you this DDEP like this, like that, something like that. But what you should know is that there is no provision that needs to be made for what? A future event. That's all. I believe I'm clear.
Yes, yes. So, sir, in this case, what do you disclose it?
For future descent.
Yes, please.
Oh, the future, yes, you disclose. You disclose, but it will never find its way on what? The financial statement. Onerous contract. What is an onerous contract? The onerous contract is that
the cost. How about the provision for debts that they normally provide?
Yes, that is why at the end of the day, they will have the actual bad debt where you have other increase or decrease in provision, where the increase in provision will be charged as an additional expenditure to the P&L, whilst the decrease in provision becomes a gain that needs to be credited to P&L. So it's all those ways. That's how we.
Okay.
All right. So we are talking of onerous contract. Onerous contract is the contract where the cost of fulfilling this thing will be more than what the benefit required. So it is what? A loss. a loss. How do you recognize them? So we said that the provision is measured at the lower of the cost of fulfilling the contracts, or the cost of what? Terminating it. What is the loss? What is the total cost of fulfilling the contract? And I told you that onerous contract is the one where the cost is more than what? The benefits. So it is measured at the lower of the cost of fulfilling it against what? The termination cost, the lower of them. You pick any of them at its best. So that is it about onerous contract. We can move now to environmental provision. That is where.
Hello, sir, Desmond.
Bosu?
Please, can you give an example of an onerous contract? Like an example.
Onerous contract. Any contract that you enter into that will give you a loss. So it means that when you continue to do it, you will run at a loss. You run at a loss. So is there any let me see.
What's the National Cathedral?
So, sir, what about National Cathedral? Is it an onerous contract?
Please, I refuse to answer that question. Because
this is not to make profit or to make loss. So you can say it's an onerous contract.
The National Cathedral is not an onerous contract because now it has become a swimming pool. People are enjoying
the highest this thing in the world.
Yeah, they are back on site. They are working. They are back on site. They are working there.
What are they doing?
Yes.
The biggest swimming pool in Ghana.
They've been cleared to continue.
Okay, so let's see future repairs to an asset. I said future repairs. We don't do provisions.
Please, what was the verdict on the onerous contract?
There is a question on that. We'll get to one. We'll get to one.
Okay.
So please, somebody should read illustration number 7 for us.
Dan Boy, a company. Okay, so discuss the accounting treatment of the financial statement for it did not come, so it's okay. Dan Boy, a company that owns several shops, has a year end of the 31st December 2021. One of the shops is loss making. At 31st December 2021, Dan Boy forecast that this shop will make a loss of 50,000 the year ended 31st December 2022. As at 31st December 2021, one of the shop buildings requires repairs. The cost has been estimated at the reporting date at 10,000 cedis. The repair is made in the following accounting period at cost of 12,000 cedis.
So they are saying that the cost of the repairs is estimated to be this. They say what? The cost has been estimated at the reporting to be this, and the cost of repair is made in the following accounting year at the cost of what? 12,000. So Danbo forecast that this shop will be making a loss of what? 50,000. How are we going to do this? Do we make provision for future losses?
Hello, sir.
No. Do we make provision for future losses?
It seems your line is breaking.
No, we don't make provision for future losses.
Is my line okay?
Yeah, it's okay.
Sir, please come again. I lost you. Sir, please come again.
Yes. So we are saying that there will not be what? There is no need to do provision for a future cost. A future cost. The reason being that there can be change, management may change the way of it operating, or there can be change in policy, change in management that will mean that that thing will never what occur. For that matter, future operating losses and then other things must not be what recognized. We only recognize expenses as being what incurred. So here they are saying that they forecast that there will be a loss of 50,000 in 2022. They are in 2021. So the accountant may be doing something that he wants to recognize a provision of 50,000 in the following year. So they said that at the December 31st, 2001, the shop required what? A repair. The cost of the repair, it is what? 10,000. The repair was made in the following year at the cost of what? 12,000. So what do? We don't do a provision for what? A future losses, and then future expenditure too. There is no present obligation that will cause you to make any what? Provision. For that matter, expenses are what? Recognized when what? Incurred. Is that not what we do?
Yes,
Is that not what we do?
Yes, sir.
So this 50,000 cannot be recognized as a provision, and then likewise the 10,000, and the amount that is incurred as painting or what repairs should be what? Recognized in the year in which it has been what? Incurred. That's all. You can't make provision for what? Future cost. That is the meaning of it. So this is the nature of how some of these questions will be what? Asked. Some of these questions will be asked. What is the answer? It said that IS 37 says that no provision should be made for what? Future operating losses. Therefore, no provision should be made for what? The 50,000 for the forecast. No provision should be made for future repairs, despite it being probable and capable of being what? Measured. This is because there is no what? This is what I was just saying. No obligation at the year end. No obligation at the year end. This is just like an adjusting event under ISO 10. It shows no what? Possible existence at the financial statement. There is no obligation as at that date. So what do you provide for? You don't provide for anything. Yes, somebody should take this one, and then I'll go to the favorite one, environmental provision. Yes.
So under new legislation, an entity is required to fit smoke filters to its factories by 31st December 2017. At the reporting date of 30th June 2017, the entity has not fitted the smoke filters required. Should a provision be made at the reporting date for the estimated cost of fitting the filters?
What is the answer? The thing is no. See, under new legislation, they are required to do what? To fix the filters. So if the company has decided to sell the entity, would there be anything? So we don't do any this thing for what? Future this thing. So let's look at the answer. No provision should be made for this future expenditure, despite being probable and capable of being measured. There has been no obligation obligating past event. The filters. So it means that even at this time, during that time, management can decide to opt from the what? From the industry. So please be careful of future provision.
Please, can you come again? The explanation on that, please.
I am saying that as at that time, they said there is an obligation that will take, there is a law that will take effect next year for you to fix something. That is the law. Then the question here is that, are you required to make a provision for the cost of that in the financial statement in this year? The answer is no. Because as at this time, there is no law, so there is no obligation as at this time. So you don't provide for anything. That is what I'm saying. And I'm saying that another typical idea is that yes, we have smoke. We need to fix it. Until the law comes into effect, we have no obligation. And I'm saying that in the future, that is what in next year. What if the entity has decided today that they are closing the business? If they are closing the business, so be it. Management, things can change in the future. Things can change in the future. Even these smoke filters that they say they should fix, where the entity has decided to use other more efficient way that will not even require what? Smoke. So those are the more reasons why we don't do what? Provision for future cost. Madam, are you okay now?
Hello, Sir Desmond.
Yes, sir.
So if the reporting period had been on that same 31st December 2017, if the reporting date had been 31st December 2017,
yes,
would there be a provision?
If yes, then there is a present obligation. Then there is a present obligation.
Okay.
Yeah. Environmental provision, galamsey. Environmental provision, galamsey. Environmental provision. What is an environmental provision? I don't know why I keep on using this galamsey. Is it something that may come? Or the questions have been set already?
So when you look at the new syllabus, the area of sustainability reporting, you would realize that it has something to do with this galamsey issue you are even talking about. Yeah.
So please, let us do something small about environmental provision. So the issue of this polluting the water bodies and other things is that you are mining at a particular area, not necessarily in the water bodies as these galamsey people are doing. Let's use a typical and a responsible mining company like Newmont, Anglo Gold, and then this Akota Mines. Akota Mine is also a reputable mining company. Chama Utmi is a very nice man. He's a very good guy. So we are looking at the situation where you
my senior at Pempekali.
Oh, okay. Hey. Oh, master.
Did you attend Pempekali?
Yeah, that's what
Pempekali.
Yeah. And he speaks English like that.
Survivor in Ghana does not depend on your brofo. If your brofo is good, and the bills in the house you can't pay, what is the value of that brofo?
Yeah. We don't measure success by the level of English we speak.
Exactly so. Exactly so. So
you can speak all the good English, but if you are not able to succeed, there's nothing for you.
Master, I can tell you on authority that Chairman Woodme can employ any member in this class today, any member, and can pay you whatever amount you require. You pay.
Hey.
Oh, you think you don't know?
That is true. Yes. Hey.
Chairman Woodme can pay anybody here who is saying
he's paying lawyers and doctors and
exactly. If you say 100,000 per month, he will pay you. Chairman Woodme can pay.
That is because of the galamsey.
Yes. So success or even we are talking in Ghana now, it's not about brofo. Master, your ability to do what? To settle your bills and then be of master. You here. If they go for any program right now, where Chairman Woodme will sit, you cannot sit there. They will give him at a position at the high table, not by way of brofo. Because of the money.
Are you people justifying the galamsey or what?
No,
we are not justifying the galamsey. We are justifying
We are
the
talking about the
how to make
English
money.
proficiency. We are not talking about the galamsey.
Yes. Mr. Wilson, have you two been watching Mr. Happiness on TikTok, who says that the value of his this thing is more than a PhD holder in Ghana?
Yeah.
Oh, that one is true.
In Africa, we are always adopting foreign languages. We don't sell our own languages, you know.
Okay, so please, that is just by the way. So let's come to environmental provision. So we are saying that at this point in time, anytime you have been given a concession of that nature, you should be able to what? To reclaim the land, and the future cost of reclamation must be factored into what? The cost of must be capitalized to the what? To the cost of the mine, to the cost of the mine. So we have done this thing under PPA already, how to what? Capitalize a provision. So the provision they will give you the future cost of this reclamation, and you need to discount it in the present value, and then you do the unwinding of what? That discount till the date of reclamation. And on the date of reclamation, you are now going to debit that liability and credit your cash. So what is the interest, the discount rate to use? The discount rate to use is the increment, either the discount rate at that time or the incremental borrowing rate of this. It should always be the pre-tax rate, just as we do for what? Impairments, just as we do for impairment. So please, somebody should read this one, and then see. Let me see what we have. Okay. My main focus is on this rather. Okay, so please, someone should read this one for us, and then let's go. Illustration number 9. Illustration number 9.
Rousley is a company. Okay, go ahead.
𝑺&𝑫 is a company that carries out many different activities. It is proud of its reputation as a caring organization and has adopted various ethical policies towards its employees and the wider community in which it operates. As part of its annual financial statement, the company publishes details of its environmental policies, which include setting performance targets for activities such as recycling, controlling emissions of noxious substances, and limiting use of non-renewable resources. The company has an overseas operation that is involved in mining precious metals. These activities cause significant damage to the environment, including deforestation. The company incurred capital cost of 100 million Ghana cedi in respect of the mine, and it is expected that the mine will be abandoned in 8 years' time. The mine is situated in a country where there is no environmental legislation obliging companies to rectify environmental damage, and it is very unlikely that any such legislation will be enacted within the next 8 years.
Okay, so Madam, please hold on there for me. So you see how the question has been crafted. So there is what? The mine costs 100 million, and then they said that there is no legislation for what? The reclamation. But look at this. The company is proud of its reputation as what?
Caring organization.
So what is this ringing in your thing? A constructive obligation. So they are telling you that they are testing your this thing on constructive obligation, and they are saying that there is no law and there's no law enacted for this to be done, and it is also not likely that some would also come in the next 8 years. But the question is holding on its what? Reputation as caring. So even though there's no law, we have to recognize the provision based on constructive obligation. Okay, Madam, continue.
It has been estimated that the cost of cleaning the site and replanting the trees will be 25 million if the replanting were successful at the first attempt. But it will probably be necessary to make a further attempt, which will increase the cost by a further 5 million cedis. The company's cost of capital is 10%. Discuss whether a provision for the cost of cleaning the site should be made and prepare extracts of the financial statement.
Good. And prepare the extracts to the financial statement. Good. Right. So what do we do? Are we going to record? Are we going to recognize a provision?
Yes.
Yes. We need to recognize the provision.
It's a constructive obligation.
Yes. We need to recognize the provision. How much is the cost?
$100 million.
5 million.
25 million.
So how much will be the cost? They said it has been estimated that the cost of cleaning the sites and replanting of trees will be this if replanting were successful at the first attempt, but will be probably be necessary to make a further attempt. So it means that what would be the value of the provision that should be recognized?
It should be 30.
It should be 30,000. It should be 30 million. Because they are saying that there is this thing to make a further attempt, which will increase the cost by a further 5 million. So the total environmental provision to be recognized should be 30 million. 30 million, just like that. In 8 years' time, and the cost of capital is 10%. It's 10%. So, just as we do under this, we will say that the cost will be 100 million. 100 million, like this. Then we will say that what will be the provision? Provision. What would be the provision?
The provision will be the 25 plus the 5.
So that's 30.
30 million. 30 million will be discounted of 1 over 1.1 raised to the power 8. Which will give us how much? What is the amount? Oh,
14 million.
14 million. How did you do it? What is the discount factor? 1.1 raised to the power.
Yeah. 13.995. Yeah.
14. Approximation.
0.46 now times 30. 1, 2, 3. Okay, somebody is saying, is it 14 million or?
Approximately 14.
Okay.
That's what confirm 40 million.
Okay, 14 million. So what are we going to do? We are going to add the cost of this reclamation or the cost of this provision to the mine. So what will be the total cost of the mine? This will be
114.
So what is the double entry? We are going to debit the asset, which is the mine, 14, and credit a provision of 14. So what will happen? What will happen at the end of the year At the end of the year, we are going to charge depreciation based on the total cost of the machine of what? 14 million. 14 million. So how much will be the depreciation charge? How much will be the depreciation charge? What is the depreciation charge? Oh, people.
114 divided by 8.
114 divided by
yes,
what?
8 years.
8
years. 14.25.
So depreciation. 114 divided by 8 years, which is, you said what,
14.25.
25.
So what is the carrying amount? 114 minus answer?
99.75.
So 99.75. That is the carrying amount as at this time. Carrying amount as at this time. Then what will be, they said, discuss the thing of the reclamation and blah, blah, blah. So what will be the what will be the carrying amount of the provision at the end of the first year? So we'll do what we call unwinding of what? Unwinding of discount. So this will be the 10% times 14. This will give us 1.4.
1.4.
So what will be the carrying amount of the what? Provision, carrying amount of provision. So we have the amount at start. Amount at start. The amount at start is 14.
14.
Then finance cost will be what? 1.4.
1.4.
So this will be what? 15.8. 15.8. So what will be the relevant financial thing that should be made? So you do your P&L extract, P&L. So under the P&L, what should be there? Depreciation. Depreciation to be what? 1.40. Then we'll have what? Provision. No. We'll have our finance cost. Yes. We'll have our what? Finance cost to be
1.4.
Oh, the depreciation rather is 14.25. 14.25. 14.25. 14.25. 1.40. And in your statement of financial position, what are the figures that should be there?
As the assets, cost of the assets.
So the asset.
The cost of the assets.
The carrying value of the assets.
The carrying value of the asset was 99.75. 99.75. Then we come to non-current liability. Then we say what? Provision.
Provisions.
And then the carrying amount is what? 15.40. Oh?
15.8.
15.8.
15.8.
It's 15.4. It's 15.40.
No. 1.4 is 15.8.
1.4.
It's 15.4. 14 plus 1.4. 15.4.
15.4.
So who mentioned 15.8 here?
It's 0.4.
Okay. So this is how you account for this thing. It's not any new thing here. Is there anything new here? No. The only new thing here is what if this provision has what? Changed. What of if this provision has changed? What of if this discount factor has also what? Changed? So let's come to reassessment of environmental provision or a dismantling cost. Please pay attention here very well. Please pay attention here very well. Because this may be what? New to a lot of people here. New to a lot of people here. Myself, it is new for a new. Is it new for anybody here? I know there are senior men here, which is not a new thing to some of us. Okay, so reassessment is the same as remeasurement of environmental provision or dismantling costs. Okay, so how do we measure this? How do we measure this? So this will bring what we call increase in provision or decrease in provision. So the recognition of this increase or decrease in provision will depend on the measurement basis of the entity. And a change in environmental provision is a change in accounting policy and must be measured prospectively in accordance with IAS 8. IAS 8. What you need to know, this one you must chew it. Understand it, don't you? Understand this. This is all that you need. And then your problem is solved. How do we measure? How do we measure these reassessments? I said it depends on the measurement basis of the entity or the policy. So under PPE, we have two models. We have the revaluation and then what? The cost model. True or false?
True.
It's true.
Revaluation model. So the recognition of the increase or decrease will depend on one or two. Good. Where the entity uses the revaluation model, the increase or decrease in provision is treated as a what? Revaluation gain or loss and measured in accordance with PPE. That's all. I take it again. There will be either an increase or decrease in provision. And this increase or decrease in provision, where the entity uses the revaluation model, it will be treated as a revaluation gain or loss. What is how is it treated under PPE? We said that revaluation gain or loss is recognized in OCI unless it is the first time revaluation that resulted in a loss, or also where the loss that occurs subsequently is more than the revaluation surplus in the revaluation account. Is that not what we usually do? Yes, so that is where the revaluation model is used. But where the cost model is used, the increase or decrease in provision is adjusted to both the provision amount and the cost of the asset. The provision amount and the cost of the asset. Any question? We are going to take an example. That's why I'm saying that please delete the first this thing that I sent. Instead of sending this one, I've sent the other one. So please, the other one was the note I used in the previous sitting. So I've made some modifications to it. So, all right. So let's take the first question. We are going to solve only one. Question number 12. So the question number 13 is for you. It's the same question. It's the same question, just that the measurement basis differ. It's the same question. Yes, somebody should read the illustration number 12 for us.
S&D. Relevant extract in the financial statements of S&D for the years ended 31st December 2018, 2019, and 2020. S&D is a mining company located in Dunkwa-Ofen in the central region of the Republic of Ghana. It acquired a plant costing 6,000 cedis on 1st January 2018. This plant needs to be dismantled at the end of its mining contract with the government of Ghana of 10 years. The dismantling cost will amount to 1,000 Ghana cedi. Discount rate at this time is 10% per annum. On 31st December 2019, the estimate of the dismantling cost and the discount rate were revised to 950 Ghana cedi and 15% per annum respectively. The fair value of the plant, including the dismantling cost as at 31st December 2020 was 3,800 cedis. S&D uses the cost model in valuing all its property, plant, and equipment in accordance with IAS 16.
Hey, let me Where is illustration 11? Okay, so it's the same question. It's the same question. Madam, read from here. It's the same question. What you have read is the same question. S&D uses the revaluation model in valuing all its property, plant, and equipment in accordance with what IAS 16. It's the same question that I used, but I've changed the measurement basis there
to cost model.
To cost model. That's all. And I've told you that we are going to solve only the revaluation. And I've told you how to solve the cost model. I said it must be adjusted to what?
The provision.
Both the provision and the cost of the asset.
That's all. That's all. So let's solve this one quickly, and then we move on. Where should I solve it under or? Okay, so let me solve it under this. Under this. So let's say answer. This one there. It makes this thing small, so please, everybody must pay attention. Okay, so 2018. 2018. 2018. What will be the cost? The cost of the plant. What is the cost of the plant?
6,000.
6,000 cedis. So let us charge the dismantling cost. Dismantling cost. If it is environmental provision, is the same thing. What will be the dismantling cost? 1 over 1.1 raised to the power 10 years. All this multiplied by what? The provision for the dismantling cost of what? 1,000. So this will give us how much? Please, let's be fast.
385.54.
So let's run it to 386. 386. So when you add this to this, it will be what? 6,386. Are we there now?
Yes, sir.
Yes, sir.
Okay. So at this 2018, we need to charge our depreciation. Is that not it? The depreciation will be 6,386 divided by what? 10 years. And this will give us
6,389. 6,389.
636.
639.
638.
That's approximately 639. 639.
639.
I'm coming though. So 639 times 12 times 10. This will give us what?
$6,390.
So you said the depreciation should be approximated to what? 6,339. That is the decision of the house. 639.
I said, this one, are we not supposed to approximate it?
Oh, anything goes now. Approximating it to the nearest whole number is allowed.
Okay.
So after charging the depreciation, what will be the current amount at the end of 2018?
5747.
5747. So this be carrying amount as at 31st December 2018. Please let us find out when was the reassessment made. So 2019. So we need to charge the depreciation for 2019 as well. Do we all agree?
Yes, sir.
Okay. So 2019 depreciation. The depreciation will still be 630 what? 9. As you said, it's a straight line. Yes, this will give us how much?
$5,108.
5108.
08. 5108.
08.
Okay. 5108. At this point, there is what? A reassessment. There is a remeasurement of what? The dismantling. This what? Mantling what? Cost. Dismantling cost. All right, let's go and see how much was this thing. It was revised to what? It was revised to 950. And the discount rate has also changed from 10 to what? 15. Is that not the case?
15.
Yes.
So what do we do? Yes.
Compare the two.
Oh, seniors, what do we do?
We need to discount the dismantling cost and check whether there is increase or decrease.
Good. Good. We need to what? Remeasure. Okay. So let us go to let's leave some space and come to our provision. Provision. What will be the provision in the first year, 2018? 2018, our provision will be how much?
386.
386. Please pay attention here. What will be the unwinding of discount at the end? Finance cost, which will be 10% times 386. Yes.
38.6.
38.6. 38.6. So what will be the unwinding, what will be the current amount of this provision at the end of first year, 2018? This plus this.
424.6.
424.60. So this is as at 31st December 2018. So we'll go for 2019. Finance cost. Cost for 2019. 2019. What will be the finance cost for 2019? Which will be what? The same 10% times what? 424.6. Yes. How much would that be?
42.46.
42.5. 42.5. So what will be the current amounts at the end of 2018?
$467.1.
467.10. All right. So at this point, there is what? There is this is 2019, sorry. This 2018. This is 2019. At the end of 2019, which is 31st December 2019, there is what? A reassessment or remeasurement of what? Remeasurement of provision. So on the same date, 31st, 12/2019. There is what? A remeasurement. And this remeasurement, how is it going to be? What is the new estimate for the provision?
950.
950. 950.
Okay.
So this will be 950 times into bracket 1 over, this one is, what is the new discount rate?
15%.
15%. So what is the remaining useful life of this asset? 1.15 raised to the power what?
8 years.
8 years. 8, sir.
Do we all agree it's 8 years?
Yes, sir.
Good. 8 years. 8 years. So how much would that be?
Confused with the date.
You said?
I said I'm confused with the date.
Don't be confused. We'll come back.
310. 311.
311.
Okay. 1.15 raised to the power -8 times 950 is giving us how much?
311. 311.
311. Somebody is saying something.
Yeah.
Yes.
311 is correct.
Madam, you were saying something.
Yeah, so I said the calculation you made after the finance cost of 425. I'm seeing 31st December 2019, 1st December 2019 again. And another 31st December 2019 remeasurement.
No. You see, at the end of at the beginning of 2018, the finance cost, the provision was 386. Are you there?
Yes, please.
In that year, this provision will be awarded by the what? The discount factor of 10%. Are you there?
Yes, please.
This plus this will give you 424.6. As at 31st December 2018, sorry.
Yeah,
2018, sorry.
Okay.
2018. So in 2019, there will be what? Unwinding of discount in 2019 based on the 10% on the carrying amount of the provision. Are you there as well?
Yeah, I'm here. So the 467 is 31st. So that one should be January 2019 or?
No, 31st. 31st, 2019. That was the date that they did the reassessment.
Okay. Then
They
I'm
said
just
that
saying
on 31st December 2019, the estimates, it was that same day that they did the estimates. Do you get it?
Okay.
All right.
Yes, please.
So let's go and see what will happen. So what will be, you said 300 and what?
311.
311.
311. Like,
yes.
So this is the provision that we should be having. Meanwhile, how much provision do we have in our books? Based on the remeasurement, what is the new provision? $311. What is the provision that we are having in our books?
467.10.
So you know that a provision is a liability. And once you have a decrease in liability, it becomes what? A gain.
Again.
Once there is an increase in liability, it becomes what? A loss. And the entity uses what? The revaluation model. And I said that anytime the entity uses the revaluation model, the gain or loss on the increase or decrease in the provision is treated as what? A revaluation gain in accordance with PPE. Is that not what you said?
Yes.
So here we are saying that decrease in provision. Decrease in provision will be the difference between this and this. What is the difference?
156.10.
156.10. So this is the decrease in provision. What would be the double entry? Or what are we going to do? How do we? We debit.
Provision. Credit P&L.
We credit the P&L, then we debit the provision.
Current liability.
So what do we do? We are going to debit. Debit what? This is a revaluation surplus. Revaluation surplus. So what do we do? We are going to debit the provision and credit what? OCI with an amount of what? 156.10. Is that not so?
Sir.
Is that not so?
Yes, sir.
Jump it.
All right. So once we are done with this, we need to go and do the needful for 2020. We are now in 2020 what? Proper. 2020 proper. So in
Sir.
20, yes, sir. Yes, madam.
Please, before we go to 2020, please, I'm confused with the 8 that you used with the remeasurement. 8 years.
Yes.
I'm a little bit confused. Please,
So
can you...
the period is for 10 years. We have exhausted 2 years from 1st January 2018 to 31st December 2019. How many years? Madam, how many years?
Sir, 2.
Take away from the total useful life of 10 years, 8 years. So that's the 8 that we are seeing there. Are you okay now?
Yes, sir.
Okay, so that is it. That is it. So let's come to the proper. So what is the carrying value of the what do we call? What is the carrying value as at 31st December 2019? 31st December 2019. So this is our carrying value as at what? 31st December 2019. This is the carrying value. This is the carrying value. In 2020, okay, so that is it. So assuming, because I'm not going to solve the other one, assuming the cost model, what should we do? Hello? If it is the cost model.
Yeah, hello, sir.
If it is the cost.
You adjust the provision and adjust the cost.
Yes. If it is this thing, we adjust the provision.
The provision and then
by
the cost.
debiting the provision of what? We are going to debit the provision. Debit the provision with the amount and what? Credit what? The asset with the amount. That's all.
That's it.
That's all. Before you charge your depreciation. Before you charge your depreciation. So the illustration number 12, that is how you should be. That is how you should solve it. I am not going to solve that one. Once you understand that this one, you can relate it to the other one because it's the same question. The only difference is the measurement base. Okay, so this 2019, this is 2019. Now, when was 2019. We are done with the 2019. Then in 2020, the this thing was what? Revalued to what? The fair value of this thing is 3,800. That is at the end of 2020. At the end of the 2020. So let's determine the depreciation for 2020. Depreciation 2020. How much will be the depreciation for 2020? It is the same what? 639. What will be the carrying amount at the end of 2020? What will be the carrying amount? What will be the? Is that?
4469.
4469.
4469. So this is the carrying value as at 31st December 2020. Now we'll compare this value to the fair value of what? The 3,800. So what is the revaluation gain or loss? What is the revaluation loss? What is the revalue? Oh, 4469 minus
669. 669.
Yes, 669. That's all. 669. 669. Now let's come to the provision as well. In 2020, 1st January 2020. So the provision has now been remeasured to what? 311. 311. So what will be the unwinding of its finance cost? Will be what? 15%. 15% times what?
And
311.
Which will give us how much?
46.65.
46.65.
46.65.
46.7.
Fine.
So what will be the carrying value of this provision at the end of 2020?
264. 264.4.
No, the carrying amount is 357.
357. So 358.
357.7.
No, so I should have added it.
All right. So we are done. We are done with the calculation. We are done with the what? Calculation. Reassessment or remeasurement of a provision, being it the number of years or the reassessment of what? The dismantling or the environmental provision cost. Any question?
Kindly show up a little.
So it means that you were not copying.
I was copying, but we were doing back and forth. We just came to solve the 2020 depreciation and then determine now.
Okay. So this revaluation loss, how are we going to record it? We have to debit the revaluation gain account with the previous revaluation of how much? What was the previous revaluation?
We have 156.10.
The revaluation was 156.10. So we are going to debit the revaluation surplus account with this amount and the excess of these from the 669 to the P&L. Yes.
Hello.
Yes.
Yeah. Any.
Hey,
No
Mr.
problem.
Okay, so let's answer the question. Let us answer the question. I believe we are okay now.
Yes, sir.
Let's answer the question and then we'll move on. Let's answer the question. The question says that we should present it in the P&L. So this is what? P&L extract. So we'll have our years to be here. 2020, 2019, 2018. Yes, what should be here? Depreciation. What was the depreciation charge for each of the years?
639.
639. That's all. Then we'll come to revaluation loss. There was a revaluation loss in 2020, which was 669 minus 156.1. Yes, that will give us how much?
512.9.
I believe that one is not giving anybody problem. 552 what?
No, 512.9.
I believe it's not giving anybody problem, right? Hello?
Yes, sir, we are okay.
Okay, so let's come to OCI, other comprehensive income. Under the OCI, what are the things that we have to bring? We have to bring revaluation gain / what? Loss. What was the revaluation gain in 2019?
156.1.
156.1.
156.10. That's all. Here, would there be any gain here? There is no gain here because the loss has been transferred to the P&L. All right. Then what of the statement of financial position? What of the statement of financial position? Statement of financial position. We'll have the cost of the asset, which is the PPE. In 2020, what was the carrying amount? What was the carrying amount in 2020?
3,800.
4469.
What was the carrying amount in 2000?
3,800.
3,800. Yes. In 2019, that's 5108. 2018, 5747. So please pick the figures for me, please. Write them down and then let me go and then you mention it for me and I'll copy. Can I go?
Yes, sir.
So this one is what? 3,800. Here will be what?
5108.
Then here is 54 something.
5747.
47. Yes, so that is it. That is it. Then we come to non-current liability. Then you come to what? Provision. What was the provision in the first year? No, provision in the current year, 2020.
That's 358. 358 for 2020. Then 2019.
357.7. 357.7. Yes. 2019.
467.1.
467.10. And then this one was what?
424.60.
424.60. No, 424.
In 2019, there was it was revised to 311.
Aha. So in the current year, where was it? In 2019, 311. So the person who mentioned this one for me, 311. And here was what? 3 what?
357.
357.7. Okay, so that is that. Any question?
Why is it that the current year's provision is not under current liability, but you send it under non-current liability?
Please, that will bring a word card for today. It's a non-current liability. Let's leave it like that. It is correct. You want to separate it for current and non-current, right? Is that what you are saying?
But if this is a non-issue, then it's okay.
It's not any issue. There's no issue. There is no issue to that. Yes.
So please, let's add the income statement, the P&L. Thank you.
Hey, please, it's almost time. Please, let's do and go away. Ish. Time. Okay, so Senior, are you done?
Yeah, please have screenshots so we can proceed.
Okay.
Thank you.
All right. Okay, so please, that is how to account for reassessment whenever there is a change in the provision or the discount rate. Anything is possible. That is what Dr. Mahmoud Baumia says. Everything is possible. It is possible. All right. Okay, so let's go to restructuring provision. What do we say?
Sir.
Yes, sir.
Let me just find out. I was thinking maybe in the P&L we will add the finance cost.
We didn't add, We didn't add the finance cost, right?
Yes, sir, we didn't.
So that is true. Finance costs. So what are the finance costs in 2020? 2020, that is 46.7. Then 2019, what is the finance costs? 42.5. Then 38.6.
Yeah.
Okay, Mr. Reynolds, thank you very much. Finance cost, it needs to come here. Okay. Let's come to restructuring provision. You want to restructure your entity. You want it to behave to operate in a particular way. That restructuring can bring about what we call redundancy. Some people may be laid off. Some of the divisions may be closed down and other things. What is the requirement of IAS 37 on restructuring provisions? On restructuring provisions. Before you can make a restructuring provisions, there are some elements that must be what? Present. Elements that must be what? Present. First of all, you can only recognize a restructuring provision if one, there is a plan for it. When we said a formal plan has been approved, it means that it has been detailed and management is committed to the what? To the plan. And the location wherever that will be affected will be what? Known and established. Then the second one is that the plan must be what? Communicated to those who will be affected by the restructuring. Okay, we are discontinuing this operation here. Segment B is going off. All the employees in segment B will be laid off. It should be communicated to the what? Affecting staff. When there is no formal plan and this restructuring is not communicated, there is no present obligation. There is what? No present obligation. Is that okay? Okay, so let's look at the cost that should be what? There. The cost that we should be what? Capitalizing under the restructuring. It is only what? The direct cost associated with what? The restructuring. The direct what? Cost. A provision should be made if the plan has also been announced to those affected. It creates a constructive obligation. Blah, 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 blah. Those things are all there. Those things are all there. So, we are talking of only the direct costs that will be incurred in the what? Restructuring. Only in the restructuring. Direct what? Cost. Necessary, entitled by what? The restructuring. No associated costs with ongoing activities. So we are talking of only what? Direct costs. The costs that should not be recognized here are, if you are relocating staff, this one cannot be what? Cannot be what? Provided as a provision. When you are marketing the product, when you are expenditure on a new system, it's just about this capitalization issue. It should be anything that is directly related. That is what? Directly related. Future operating losses. Then profit on disposal of what? Asset. Assuming you are going to do what? We are going to dispose of segment A, and that all the assets here must be what? Sold at a cost, and the proceed will be what? 5,000. We are saying that these profits on this disposal, should not be netted against any what? Direct cost of restructuring. Any direct cost of what? Restructuring. All right. So let's take illustration number 13. On 14th June 2015, a decision was made by the board of S&D to close down a division. The decision was not communicated. One of the conditions is that there must be a formal plan, and it must be communicated to what? The affected person. One is not communicated, provision can never be what? Be recognized. Are we all there?
So that's what?
Yes, sir.
Must all the conditions be satisfied before we can make provision?
Not really. Not really. But in a situation where they must, where the two conditions are present, they must be met. They must be met.
Okay.
So this one was not communicated. Once it was not communicated, we cannot what? you don't need to even continue. They say it was not communicated at that time, and no other steps were being taken to what implement. So there's no formal plan here. That this thing was not what communicated. For that matter, we cannot make any provision for restructuring. We cannot make any provision for restructuring. 14. On 15th December 20, a board of S&D voted to proceed with two reorganization schemes involving the closure of two factories. S&D reporting period is 31st March each year, and the financial statement authorized for issue on 30th June. On Scheme 1, the closure cost will be 125. The closure will be announced in June and will commence in what? Will commence in August. Will commence in August. So what is the requirement for each of these? So we were told that S&D reporting period is what? 31st March. And then the financial statements are authorized on 30th June. 30th June. So what can we say about Scheme 1? What can we say about Scheme 1? They said that the closure amount will be 125 and the closure will be announced in June and commence in July. So what is that? So it occurs after the financial statement will even be authorized for issue. Is that not the case?
Yes.
So can there be any provision?
No, sir.
No. Scheme 2, the cost will amount to 45 after crediting 105 profits on disposal on the setting machine. Please, what did I say about profit on disposal?
He said no.
Please be netted with.
So what will be the cost? That should be what? What should be the cost? It should be what? 45,000 plus what? 105. Is that not it?
Yes, sir.
Yes. So what will be the amount? 105.45.
555. 555.
45 plus 105. That will give us what?
145.
Oh, no.
150.
150.
Yeah.
So this
Sorry,
150 should be what? The recognized what? The recognized amount of provision. We don't net it from any profit. We don't net it from what? Any profit. We don't net it from any profit. Any question?
Sir, please kindly take it again. The 150.
They said that this 150, after crediting, the total cost was what? 45,000. They said this one was done after crediting what? A profit from this. So this amount, there is X amount was deducted from 45, and they had what? 105. Is that not the case? So
yes,
X
sir.
will be equal to 105 plus 45. Therefore, the amount is what? 150. This is what I mean. This amount, this was the net amount. So all restructuring, this thing must be recognized at their gross amount, not the net amount. Restructuring.
Okay.
All right.
So
thank you.
Mentioned about disposal, profit from disposal or income from disposal is not part of the.
No, please. No, please. Okay. So what do we have? Claims and counterclaims. Claims and what? Counterclaims. Claims and counterclaims. What do we say claims and counterclaims? I have a claim. A company, a customer has sued S&D for some damages. Maybe they bought our product, our fruit telly. Hey, no, let me not use any product here. From our fruit juice.
S&D juice.
Yes, S&D juice, that's it. Now, after that, the person has developed some stomach this thing, and then it has resulted in a what? A poisoning. And this customer sued S&D claiming damages of 50,000 Ghana cedis. Upon receipt of this claim, this is the claim against the company. So this is what they have filed. The person has filed for this. So whether you will be liable for this claim or not will depend on what? The probability or the outcome of the case, which your lawyers would what? Would advise on your probability of losing or gaining or being liable or not. If it is in the wisdom of your lawyers that you will be liable to pay that amount, then you need to recognize what? A provision. But if it is not likely that you may pay that amount, then you have to do what? Disclose it. That is about claims. Now, let's come to counterclaim. The counterclaim here means that after they have sued S&D, S&D too was advised by its lawyer that the component that you use to produce this fruit juice was bought from XYZ company. So we also file a suit against X and Y company. That is a counterclaim. Do you get the difference? A counterclaim against our supplier that he is the cause. Please, are you getting this thing of the counterclaim?
Yes, sir.
Or there could be a court case. The court case is that this person says that I have been on his, I was owing him so and so and so and so, and in actual fact, I don't owe him anything. Then I would rather say that no, you are counterclaiming that he is the one rather who is owing you, because the amount that he has taken, it amounted to an interest cost of so and so and so. That is about what? Counterclaim. How much will you recognize or disclose as a counter what claim? You know that a counter claim is a possible what? Asset. Because if you have succeeded, the XYZ company will pay you. So this becomes what? A contingent asset. So this contingent asset should be what? Should be disclosed. How much do we disclose? You can only recognize this if it is virtually certain that the amount will be what? Received. That is, the X and YZ has accepted the liability and they have promised to pay. And there is evidence with signatures and other things to read that they will pay. That one is certain. You can recognize it of the amount. But in the case where they have not given any firm commitment, how much do we recognize and disclose as a contingent asset? How much? The contingent asset should not be more than the amount being claimed by the customer. That's the fundamental. It should be more. If the customer is suing you for 50,000, you cannot go and counter sue your this thing for an amount more than that. So the best estimate. Okay. So what of court cases? What of court cases? What will be the liability, the provision for a court cases? What will be for a court case? the court case will be what? The most likely outcome. All right. The most likely outcome. So this is about counterclaim. Illustration number 16. We said that an entity has received a claim for damage, the damaged goods from a customer. The entity legal advisors believe that it is probable that the settlement would need to be made of what? 10,000 in favor of the customer. So do we recognize the provision here?
Yes, sir.
Yes, we recognize a provision of 10,000 based on the advice of our lawyer. He said we'll lose the case. However, it is in the opinion. However, in their opinion, it is also probable that a counterclaim by the entity against its supplier for a contributory negligence would also be successful to recover the damages. So what would be the contingent asset that needs to be disclosed? What will be the contingent asset that needs to be what? Disclosed?
Not more than 10,000.
Not more than 10,000. Not more than 10,000. Reimbursements. Reimbursement is about insurance. Reimbursement. The insurance reimbursement. So insurance people would what? There is a fire outbreak and blah, 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 blah. You have insured your property and you have reported to your insurance provider, and they have accepted what the liability that they will do. So the provision that should be recognized, the recognition of any reimbursement is restricted to the amount of the related what provision. Is related to what the amount of what the provision made. The provision. So it should not be more than what the provision, just as the counter claim. Any question? Please, if there is no question, we are done for IAS 37. IAS 37. The illustration 17 is your assignment. Please do it.
So we didn't do illustration 15.
Oh, must we solve everything? What is the illustration 15 about? What was it about? We have skipped it, right? We have skipped it.
Yes.
What is it about? Read it and then. Okay, so please.
It's about the redundancy.
So please, okay. Look at this one carefully. Somebody can read it for us.
Okay, so the 17.
Yes.
Okay, so replied. Show how the above should be treated in S&D's financial statement. S&D Limited has two potential liabilities to assess. The first is an outstanding court case concerning a customer claiming damages for losses due to faulty components supplied by S&D Limited. The second is the provision required for product warranty claims against 400,000 units of retail goods supplied with 1 year warranty. The estimated outcomes of the two liabilities are: court case, 65% chance of damages of 2 million Ghana cedis, 25% chance of damages of 5 million Ghana cedis. Product warranty, 20% of sales will require a 20 cedi Ghana cedi minor repair. 10% of sale will require a 25 major repair. Thank you.
So the provision for a court case must be what? The best what? Estimate. So please, you are to do it, and then I believe we can all do it, right?
Yes.
Yes, sir. Yes, sir. Yeah.
No.
Let's discuss.
Huh?
So please, let's go with this, then we can.
Okay, so choose between this one and illustration 15 that you were saying.
Okay, so illustration 15.
This one no choose BD. This one should be all.
Hey, you people, you people.
The full benefit.
So let's see how it should be done. Oh, but this thing, we have done this thing already now. We have done this thing. What is the probability? The warranty, and then what? What? The second is the provision required for a product warranty against 4,000 units of retail goods supplies with 1 year warranty. The estimated outcome of the two possibilities are: one, the court case. The court case, there is a 65% chance of damages of 2 million. So I said that the provision for a court case is the best the best estimate, and 65 chances of what damages there. So Anna. Yes. So this one, court case is what? What is the provision required? 4 million, 2 million. Is that not it? The court case, the chances of you being liable is what? For 2 million. Then there is 25 chance of the damages being what? 5 million. So this one, it is what? This one, it is probable. This one, it is what? Probable. And it must be what? Recognized. Come to the warranty. The 20% of sales will require a major what? Repairs. 25% of it. But you already know this one already. Minor repairs. How many units were sold? How many units were sold? For minor will be the 400 units, no, 400,000 units, multiplied by the units of the minor to be what? 20 cedis, times the probability of its occurrence, 20%. The major will still be 4,000 units that was sold, times the probability of its occurrence of what? 10%. 10% times the costs of each major repair, 25. Put the amount there, and the total becomes the provision required. Is that okay? Said one. You said?
Did you say the 25 will be recognized?
Yes, now. This is probability. Warranty. The warranty is that the major repairs, 20% of the sales made on 20% of the sales made will require major minor repairs. Then 10% will require what? Major repairs, and they all have their what? Sales. They all have their cost of the repairs, multiplied by the units sold in total, times the probability of the percentage of their occurrence. That's all. Is that okay?
Yeah, please, can you come again with the court case?
The court case should be recognized on what? The best estimate of what? The outcome. You cannot say that we have two damages. One is 25% chance of the damage being paid. The probability of paying it is 25%, and one is what? 65%. So this one is remote. Is what? Is below the thing. It's not probable. It's not probable. But this one is what? Probable. This one is possible. This one should be what? Disclosed. This one should be recognized. Are we there?
Yes, sir. The 25%, although we will not recognize, we have to disclose it, right?
Exactly. Disclosure. Disclosure.
I said the 65 should be recognized.
Exactly so.
Yeah.
Exactly so. Okay, so when you do this, the the amount here, add them here, and that will be the total provision. That's all. That's all. So please, hi.
Sorry, sir, I've gotten it.
Okay, so please, that is this for now. At 3 a.m. tomorrow, we are doing IAS. We are doing IAS 12 for 1 hour. We are doing IAS 32 for additional 1.5 hour before church tomorrow. Then after church, we'll come and use the 1 hour to do IFRS 9. Then we'll use the 2 hours left for what? IFRS 16 leases. These are the plans for tomorrow. These are the plans for tomorrow. And then within the week, we'll find a time to do IFRS 15. Then tomorrow will be the end of the official listing for the standards. So these are the things that we need to do. Tomorrow, 3 a.m., IAS 12, income tax. It has been off the radar for some time now. Then we can also concentrate on IAS 32, financial instrument. Then financial instrument after church will continue and complete it and do IFRS 16 leases. The leases, the most important thing that we will talk about is reassessment of lease obligation. Reassessment. When the lease period has been extended. When the lease period has been what? Extended. So these are the plans for tomorrow. Okay.
Oh, sir, how can one keep these plenty things in one small head? Hey, this standard. Oh, no. And you have family issues, you have work issues, social issues, and political
I've done tomorrow, right?
Exactly so, boss. Exactly so.
Yeah, no problem.
So some of us have a case at 2 p.m.
Oh, man.
It is recorded, so you can go.
You see, what
is the amount of the restructuring provision to be recognized in the financial statement of Delta PLC for the year ended 31st January 2012?
Yes, please. Hurry up.
On
Somebody wants to.
June 2012, the directors of Delta decided to close down a division. This decision was announced to the employees affected on 15 January 2012, and the actual closure occurred on 31st August 2012, prior to the 2012
July. Be careful. You are saying January.
Be authorized for issue on 15 September. Expenses and other items connected with the closure were as follows. Redundancy costs, staff training, operating loss for the 2 months of 31st August 2012, profits on sale of property